Well, another very volatile day on Wall Street. Today, trading stopped for the first time in a decade. The combination of crashing oil prices and renewed fears over a coronavirus outbreak sent stocks plunging 7%. That drop in the S&P 500 and the Dow Jones sliding 1,800 points within minutes of the opening bell led to an automatic shutoff, halting all trading for a full 15 minutes. The administration has called on Wall Street executives to meet with President Trump at the White House to discuss the response to the outbreak.
And here now for more on today's stock market plunge is Joel Griffith, research fellow with the Heritage Foundation focusing on financial regulations. Joel, thanks for being here.
Thanks for having me.
So what should most Americans make of what we saw early this morning with the stock market plunge?
But it's important to not panic and make the decisions that we make fully informed as possible, and talk to our advisors, and also realize that although this type of a plunge overnight is rare, we haven't had a drop like this in years. This was on par with the 2008 drop of around 8%. The markets over time have, up until now, always recovered. It might not be next month or next quarter, but we need to keep, if it's for retirement purposes, we need to keep that long-term picture in mind.
So we saw or witnessed what's called the so-called stock market circuit breaker. Can you explain what happened?
Yep. So overnight, traders can go ahead and trade what's called the futures, and that gives an indication of how far up and down the market will open, and that actually triggered a stop. If the market moves on the downside more than 7%, they actually have to pause in trading. So when the market opened this morning, it very quickly hit that 7% level and had to freeze until about 9:50. And then there's another stop. If it goes down 13%, it also has to stop. If it goes down 20% trading, if it's not late in the day, it's done for the day. So we've actually seen a bit of a rebound since then, but that's really put in place to allow people to think clearly, get their wits about them, because you don't want to see that panic spread needlessly.
Yeah. Amid the coronavirus fears, we're also seeing oil prices, plunging. Are these two connected, Joel?
So they're somewhat interconnected, but we've seen oil prices weakening over this quarter, and that's largely because there has been a decrease in demand, and a lot of that decrease in demand has been because the coronavirus has caused economic output and activity to decline in China. But what we saw this weekend, that has not happened since 1991. We saw oil prices plunge about 30%, but that was unrelated. That was a situation where OPEC was trying to work together with Russia to try to suppress production, and Russia at the end of the day said, we're out. We're not going to participate in this. And so now Saudi Arabia has promised to just have a gusher of supply hit the market, a huge increase of 7 million barrels per day next month.
You had mentioned the earlier stock market reaction that was similar to the one that we saw today. How has this market reaction, though, been different than previous outbreaks?
If you go back 35 years, we've seen basically 11 epidemics that have occurred across the globe. I think it's really interesting to look at what's happened 6 months later. And even one of those instances, our stock market has actually been higher than the day prior to the outbreak. This one is a bit different, both in terms of the virus, but also we're in a social media age, and we see information, whether accurate or not, spread a lot more rapidly. And so I think that having that information can be a positive because we're able to be alert to what is going on, but in some cases it actually enhances the fear, and not always is that fear warranted. And I think that is part of what we've seen the last few weeks with the volatility in the market, and now being down 20% over the last few weeks.
All right, Joel Griffith with the Heritage Foundation. Thank you.
Thanks for having me.